A balance sheet sets out the financial position of an organisation at a moment in time. It's a snapshot at that particular point, and it sets out the assets, the liabilities, and the equity in the organisation. The long-term assets are assets that are deployed in the organisation in a period longer than a year. So it's things like plant and equipment, it might be buildings, motor vehicles, IT hardware and software. These items are used over multiple accounting periods typically. And then we have short-term assets. Short-term assets are where we expect the assets that we expect to turn into cash, are either cash, because cash is included there, but if not, then we're expected to turn them into cash in a reasonably short period, certainly a period less than a year. And these will be things like receivables from customers. So we build the customers and they've not yet paid. We expect to collect in the coming weeks and months. Secondly, it may be something like inventory or some kind of work in progress that we've done and we haven't yet billed and collected. So these will all sit in short-term assets. And then we have short-term liabilities. And again, there's this 1 year window. So these will be payments that are due to our suppliers, so our trade creditors, but also it'll be things like payroll taxes that are due. So that sit in short-term liabilities. And then we have longer term liabilities. These are liabilities which are not due for payment within the next 12 months. They're due for payment beyond the 12 months. And there'll be things like long-term lease obligations. We could well be signed up to those. Maybe we've bought a business and we haven't yet paid the full consideration to the sellers of that business. That often happens. So if the amount's due in more than a year, that will sit in long-term liabilities. Also, we may have received a loan and the loan providers don't require payment. They might require payment in 2 years or 3 years or 5 years or stage payments and so on. The amounts that are due in over a year will be included in this long-term liabilities. And then we have this section called equity, and this equity represents the shareholders' interests. It's the amount the original shareholders subscribed to be able to buy shares in the company. It's the amount of money that was put in by shareholders into the organisation at the outset, but also whenever shares have been issued, but also it's a representation of the accumulation of the profits that have been left in the business, the accumulated profits over the years that have not yet been taken out in any form of a dividend or any other type of distribution. So that's really what a balance sheet looks like. And of course, we can look at it as, and it's called a balance sheet because it's two halves balance, the total assets, in other words, the long-term, the short-term assets, they're funded by a combination, the total of the short-term liabilities, the long-term liabilities, and the equity. Another way of looking at the very same information is to think along the lines of the invested capital in the organisation. And there's only really two classifications of investors in the example I presented, and they're the long-term debt holders. They're essentially sitting in the organisation. They've loaned money to the organisation because they believe in it. They're looking for repayment, and they're usually looking for interest along the way. And secondly, it's the shareholders who again have subscribed for shares. They believe in the business. They've invested in the organisation, and they're looking for a combination of a return on their monies. They're either looking for a dividend or they're looking for the value of their shares to grow over time, or both. But these are two forms of invested capital, and of course that invested capital has been used to fund the remainder of the non-current, the net of the total assets that have been acquired, which have also been partly financed by some short-term liabilities and some element of long-term liabilities. So we have this invested capital concept where the investors are really looking for a assurance that management are adequately managing the funds at their disposal, and of course over time they're looking for a return. So then we've got a third way of looking at the very same information, which is just to look at the shareholders' interest. And of course the shareholders' interest is a smaller number than the invested capital, because the shareholders' interest has to find a way over time to repay the debt to the debt holders. So this gives a visualization of the shareholders' interest in the organisation, and it shows the net assets of the organisation that the shareholders own. And finally, somebody may come along and say to the shareholders, we want to buy this organisation and we're prepared to pay more than the book value of your interest in this organisation. And if that's the case, which they may well do, then we have this concept of off-balance sheet assets called goodwill. And of course, why would anybody pay any more than the book value? Well, the book value doesn't capture necessarily the value of the brand, the value of the leadership, the value of the customer relationships. So that's what the buyer will be paying for, in addition to the book value of the assets that are set out on the balance sheet. In what ways can we contribute to enhancing the on and off balance sheet value of the organisation that we serve?